Hello, everyone, and welcome to the second episode of Investing for Good, a podcast about all things impact investing. I'm Katherine Fox, founder of Sunnybranch Wealth, and I'm joined by Josh Hile, my co-host here today. We're going to be talking about impact investing myths, what they get right and what they get wrong. Josh, how's it going?
Great to be here. And just as a quick introduction, I'm the CEO and CIO of Citizen Wind. We provide private market impact investments to wealth advisors.
Awesome. Thanks, Josh. Josh and I met a while back. Both of us are in the impact space. I am a wealth advisor that focuses on impact investing and positive investments for my clients. And we decided to start this podcast so that we could share some of our knowledge with the world and also talk about a lot of the questions that probably I more than Josh have about the space. So I mentioned we're going to be covering impact investment myths, sort of where these myths come from, why they're not true, if there are elements of them that maybe have some truth, and where we hear these myths coming from. So I'm going to start with what is probably the most common myth that I hear, talking about greenwashing. So the concern that impact investing is just greenwashing. For those that don't know, greenwashing is when you have an investment product. So maybe it's a mutual fund, maybe it's a private investment, an alternative investment that claims to have some impact benefit, but really it's just sort of putting a coat of green paint on it, if you will, pretending that it has a positive return or a positive impact component of the return in order to generate sort of some buzz and hop on that impact investing bandwagon, but it really isn't doing what it says it is. Greenwashing is a thing. We would both agree on that. But that doesn't mean that it's a brush that we should paint across the entire industry. So Josh, what are your thoughts on this?
Yeah, I think there's greenwashing everywhere in the investment industry, and people are usually utilizing it for their own means. And so it's in most cases, it's raising capital, and it's like, okay, how can we change this messaging to raise capital from a greater group of individuals? And so to some, I can present it this way, to others, I can present it this way. And from an impact lens, I can say, yes, this is helping so many people are doing this, but it's not actually having the impact that we would want or expect, or having a dramatic change to the industry. I think what I've seen, like even to a certain extent, is like all VC investing is impact investing. I've literally heard this pitch. It's like, well, could we create jobs? And jobs are great. And it's like, okay, well, that's awesome, but what kind of like specific issue are you solving at maybe if we were in a huge unemployment issue, but at the current point in time, it's like maybe it can be impactful, maybe the underlying companies can be impactful, but they're not solving a specific issue. More what impact investing is actively addressing one of the major issues we might be facing at this current point in time. So some of these big issues could be around climate change with energy transition that we're dealing with, and like trying to reduce that in some form or fashion with renewable power or better sustainability. It could be around affordable housing. I mean, everybody in this country, it's a bipartisan issue. Affordable housing, affordability is a huge issue across the landscape. And it's something that, maybe the one thing that Republicans and Democrats can agree on is that we need more affordability. Education is a massive issue in this country. Healthcare is a massive issue. Water scarcity, while not the biggest issue in the US, is a huge issue across the world and will continue to be an issue. So these are more the big impact opportunities that we can see. So it goes beyond just like that, like creating jobs. It's more like, hey, how am I impacting this big opportunity set? And that's what ultimately we're trying to do when we're reviewing an impact investment. And it goes beyond just, talking to a manager. It actually goes to, okay, well, let's actually see that impact in play. And are you actually doing what you're saying you're going to be doing? So like from a diligencing perspective, we're auditing these managers, or going and talking to references. We're like saying, if they are pretty affordable housing, let's see the pricing of this housing. Let's compare it to what market rate housing is. And if it's above market rate or it's market rate, then that's not necessarily what we're trying to impact. So it does take a little bit more work because people can tell a story, people can lie and or tell close to truths, but that aren't truths or are truths in some manner. So we need to like really spend some more time about it. But it isn't true impact investing is not trying to be greenwashing.
Yeah, I am familiar with some investors who do a lot of biotech, like early stage biotech or pharmaceutical investing, and call that impact investing because those products are going to go on to save lives, which is true, but I think is also sort of counter to this, what I would call, and I think what we would agree is sort of the spirit of impact investing is that you're sort of solving intractable, what feel like intractable problems in our society, and you're bringing capital to find creative solutions to those problems. So if you're talking about like solving disparities in healthcare, then yes, I would think that that qualifies as impact investing. But if you're just talking about sort of funding for pharmaceutical companies, does that really check that same box in the same way? And I think there's also some element, obviously at Citizen Mint doing a lot more work on the private side. There's a lot of due diligence there. And I think it's really important points for anyone listening to understand that you do have to do a lot of diligence on the private side to understand what you're investing in and what the impact that's being created through that investment is. And also to understand what are sort of the negative externalities of that investment, right? Where, oh yeah, maybe you do have an affordable housing program, but maybe maybe you're like displacing people who already live there. Maybe you're like raising a neighborhood to build affordable housing. That's not what you want, right? And so it is easy, I think, for individual investors, especially, but also for investment advisors who are interested in the space just to feel so overwhelmed by the amount of the diligence that needs to be done. And I think that's like obviously where you provide so much value, especially as someone who's a smaller firm. I don't have a CIL, I don't have an 8-person analytics team. So having, an expert there that can help with that diligence process. And I think talking about greenwashing in the public markets, there, the individual consumer or an advisor is a little bit more able to do some of that own research themselves. And I think that is where, for advisors or investors who are interested in learning more about impact investing, that can be a really good place to start, is to look at just, some of the big ESG or impact focused funds. Just go on Morningstar and look at the portfolio of those funds, right? See what kind of companies they're investing in and see, when you look at what's in there, if you would really consider those companies to be impact focused companies. Obviously, like, there's a bit of a difference between impact investing and ESG, which is actually, it's going to lead me to our second myth. Not sure if this is so much of a myth as just a super common misconception about impact investing being the same as ESG investing. Josh, you want to enlighten us here a little bit?
Of course, this is my favorite one. Actually, as it's people are like, oh, you run an ESG firm, and I'm like, well, no, I don't. I run an impact investing firm and like a compelling private markets firm, and so it's one of those things where ESG is really the negative externalities of an operating business. And so as you're operating a business, you're going to have negative externalities. So you think of like Amazon, it's like it has a ton of trucks on the road. So it's putting a ton of carbon in the air. That's why they made an investment in Rivian to try and like decrease that carbon output. They use a ton of wood products and boxes, but they're trying to reduce like package waste with all that. But those are negative externalities of their business. That's real externalities. They also have like, like job issues and people get hurt, and it's like, how do we improve that? And those are real liabilities to the company over time. Or you think of like 3M and the manufacturing business, and they have these long-term environmental negative externalities that might not be on the balance sheet right now, but at the same time, it's something that could be a liability to the balance sheet in the future, with like long-term chemicals or anything into groundwater and all those kind of things. Or, I mean, even if you're treating your employees poorly, that's not a balance sheet issue per se. It's not able to be captured in the balance sheet, but that's a real issue that they're facing. That's a negative externality in their business because they won't be able to attract good employees compared to some other firms that can attract some of the best and most brightest employees. So impact is really like focused on these specific issue areas that we can help solve while also gaining, like looking for a financial return in those specific issue areas. And there's multiple different variants in that. Some people want to be more impactful with their investments, which also like they can be concessionary in the return expectations. For us as Citizen Mint, we've focused on areas where we know we can have an impact and we know we can get market rate or better returns on everything we're doing. But that is really in those focus areas of, affordable housing, renewable energy transition, education, sustainability, etc.
And a lot of for people who are newer to the impact investing or even the ESG space, there is confusion around those terms because what is publicly available and known are mostly ESG funds when you're talking about private markets, like sort of the big funds that you might know or come across. A lot of those are going to be ESG funds. And so when you think about creating impact in the public markets, do you think, where do you see the shortfalls there? If you say, okay, I understand the difference between impact and ESG investing. ESG investing, you're sort of screening out for negative factors. You're trying to get kind of the biggest risk factors that you see out of the portfolio, those biggest negative externalities. I don't want to do that. I want to create positive impact. Do you feel like you're going to be able to do that using just the public markets, or do you think that they're going to fall short? And if you're interested in this question, we do have a whole episode about it last time. So check out episode 1. Little plug.
Yeah, no, definitely. I just think you're going to fall short on a lot of those. There's just not, when you're a publicly traded business, usually you don't have a specific focus on one specific impact area. Even like some of the big REITs out there, they might have a small portion of their portfolio investing in affordable housing, but most of their housing is market rate or luxury. And so it doesn't really hit that metric of like, yes, I can actually affect this specific issue by investing in this company. That's not really the case. Whereas like in the private markets, it's like, I'm going to address this issue head on with this very specific investment. It's meeting my financial return hurdles as well as my impact hurdles. And so you can really pinpoint those exact areas that you really want to affect from a personal perspective.
Talking a little bit about returns, you mentioned concessionary returns and how Citizen Mint is really focused in its key impact areas of market rate or above market rate returns. The next myth on our list is that impact investing is concessionary. So if you want to create impact with your wealth, you are necessarily going to have to take a lower than market rate return. And I think this may have been true to some degree in the very early days when people were just starting to think about impact investing. It very much is not true now. So can you talk, Josh, maybe a little bit about that evolution and what it looks like in the impact investing space with alternatives in terms of return profiles?
Yeah, no, definitely. And I think this is another one where people will be like, hey, I'm not interested in concessionary returns. That's literally what they'll say to me like first thing. Or like, my clients aren't really interested in this. And I'm like, okay, well, let's rephrase it and then let's think about it from that perspective. And it's like, would you be like, so this is an example for renewable infrastructure that like, oh, I don't really have many clients who are thinking about renewables or impact. And I was like, okay, do you want to invest in the largest capital investment cycle of all time? And then they're like, well, tell me more about that. And I'm like, well, it's the same thing. And because we're doing this massive energy transition that's going to take trillions, and it's where big institutional investors are putting up big this will be, and you can invest alongside those big institutions, but you're having a positive impact. And they're like, okay, well, that sounds great. And then I go on to say, okay, these are 30 to 50 year duration projects. That means that these solar, wind, biogas projects, they last for 30 to 50 years. and you have an off-taker agreement with Amazon. And so as long as Amazon doesn't go out of business, you're getting paid that income for the next 20 to 30 years. And Amazon and Microsoft and Google and Meta can't buy enough of this energy. And they all have 50% energy chains that are trying to sign every contract that they possibly can for their data centers, which now take 4 times the amount of energy because we all want AI. And so it's like, that seems pretty compelling. And it's also impactful because you don't have to use coal or you don't have to use oil or these other places. And it's like, yeah, you need those things for the transition period, and you need those things like before batteries are in place and other things. And this is going to be a long-term cycle. And there is some negative externalities. There's real natural resources that are used to produce these things. But over the long term, it's much better than some of the current energy that we use for these specific operations. And it's going to help climate, and it's going to help these companies hit their carbon goals, which they are all committed to hitting carbon neutral by 2030, which is going to be incredibly difficult unless they invest here. So it's reframing that for them to understand just the return profile and how big of a opportunity this can be. And on top of this, the government gives you 30 cents on the dollar for every dollar you put into this. So they're incentivizing you to put money here. So it is just a really it's getting them to understand that level of that. It doesn't need to be concessionary. There is ways to make capital here. And you should take advantage of these big transition opportunities. And that said, once I mentioned that Blackstone has one of the biggest affordable housing funds in the world, and Apollo has a massive infrastructure fund, and all these other places where there's these big companies understand the big opportunities here. They might be doing it for different reasons, but they understand that it can, or that there's return generation there. Then they're like, it kind of flips a switch, and they're like, okay, this is something I should be paying attention to.
Yeah, I think it is helpful to understand it and to think about it as a long-term investment. And I just think from a personal viewpoint, so much of what we invest in, we don't see the costs of the true costs of that, the natural resource costs of what we're investing in, the human labor costs of what we're investing in. And you just have to think at some point, right, that is going to come back to you, right? These costs, they're not visible. I mean, they're visible to a lot of us. You don't see them now in your investing returns, but they're there. We all know they're there. It's clear. And so it just seems short-sighted to me to not be diversifying, your portfolio or anything like that, with an eye towards what's going to happen in the long term. Right? What does 30 years look like? What does 40, 50 years look like?
Yeah, exactly.
Can't be the same as today.
Yeah, 100%.
So the last myth we have is a lot of people who think that their money doesn't matter. So why would I say, okay, you've convinced me. It sounds like a good idea, but I just don't believe that my money would really make a difference. And that may be a large investor, it might be a small investor, but this idea that what one of us doesn't matter. And I think it is a little bit of a dangerous idea, right? Because if everyone thinks that, then nothing happens. And I hope that if you have listened to this point, that at least even if you think that your dollars don't matter, you're at least convinced from a return, a proof of concept point that, I don't think they matter, but I still think this is a great thing. But I think there is so much importance that, individuals can have. And a big reason for that is the more people that put money in these impact, even if it's ESG impact or ESG, something that shows that people want their wealth to create positive impact, the more the market responds to that. And working with millennial and Gen Z inheritors, that's what I know my clients want. And so I know there's a market there, but the broader financial industry is very old-fashioned, very conservative. And so they might not believe in the strength of that market as much as I do. And Josh, I'm curious about your perspective on this, given that Citizen Mint is such such a unique position in this space, such a unique opportunity for people to invest in these really long-term impact opportunities at lower minimums, so you don't have to have $250,000-$500,000. You can start investing in renewable energy or investing in affordable housing, with tens of thousands of dollars versus hundreds of thousands of dollars. Is this an attitude that you run into with people often, that they just don't feel like their money would make a difference?
Sometimes, and I think it's one of those things where we like I try to frame it in a different way when I'm talking to individuals, because I think, it's like private capital is what's really going to solve these big issues. We're not going to depend on the government or any other forces. It's really going to be private capital coming together in a collective manner to put their money where their mouth is and say, okay, if I believe in this, I should be putting my capital there and aligning my capital with my values, which is very different from prior generations who said, okay, my profit center's right here, my philanthropy center's right here. They can be in total opposition to each other, but that's okay. Whereas the next generations are saying, okay, I want my values aligned. And so what we've tried to do is, like democratize that to an extent where people can say, yes, I will have a difference. And we can actually quantify that difference through our impact reporting and metrics, where it's like, this is the actual impact you're having. And it might be like, yeah, we're aggregating the capital together to make it happen. But if we can get access to these amazing managers who are doing really impactful work in really impactful places, then that will have a significant difference. And that's why we're trying to engage investors on it, where we're like, here's the difference you actually did have. Here's the pictures of the building you were building. Here's some of the tenant surveys of like the impact it had on those people's happiness. Those are just things that you can like hang your hat on and be like, okay, I am making a difference in this thing I care about. And it's like, yeah, it's probably not as fast as you want or as much as you want, but it is like being able to utilize your capital for good, as well as secure your financial future, which is ultimately the goal that like you're going out to clients and helping them with. And I'm on the back end trying to help you with that.
Yeah, it's interesting to think, sort of just talking about these myths and thinking about the roots of where they come from and what societal attitudes and also the landscape of the financial industry has kind of informed, um, this way of thinking. And it's as I mentioned, it's something that I see changing among my peers, whether that's my friends or other financial advisors who are kind of the same age, that we think that it's very important. And I think there is sort of this tide of people who have or will have wealth, and these things are really important to them. So like I believe in sort of the tide that's coming up, but I'm curious how you sort of see it. Not that like you are older, but you interact with more of the financial advice industry. Like, are you seeing the same interest from older advisors, or do you think like we're really going to have to wait for like our generation to come up before anything changes?
I think it's an education piece for me. And we spend a lot of education or time on education. So around like white papers of why this is a compelling opportunity, giving them case studies on like why they should be invested here. I, I think it's, I think there's like, you have a media side to it that might like put out something that's like unnecessarily true, or they have this preconceived notion around like different words, and then it's being able to explain to them in common language, like I said about like renewable infrastructure. It's the largest capital investment cycle of all time. Do you want to be an investor or not? And then once you kind of reframe that for them and kind of have them understand the opportunity and lay it out there, then they're like, oh, okay, this makes actually a lot of sense. I think it's going to take time in the sense of like that education piece, which it always does. Anytime it's something new, it does take time. But once they understand, and they also understand how even the return side of it, and beyond the impact, that's where I think the switch flips. And so it's like any adoption cycle. It takes time, it takes time, it takes time. And then there's this version point where it's just like everybody starts doing it because, people are talking about it. And so, yeah, so I think we're not that far off from that, honestly. There's some people who aren't going to do it because they're just not comfortable with private market investments. But for most, I think we're getting to that conversion point where they will start doing it.
Well, that is encouraging to hear. Hopefully, we see it sooner rather than later.
Exactly. Exactly.
Well, Josh, thank you for another fun conversation on impact investing. I hope this was interesting to anyone who is out there listening. If you're interested in connecting with either of us, you can find me at sunnybranchwealth.com. And Josh?
And you can find me at citizenmint.com.
And we will be back next month with our next episode, and we'll look forward to chatting more then. Now we are going to stop.